Okay, so welcome to Enhancing the Accountant Bookkeeper Connection series. And I hope everybody had an awesome summer. And yeah, we'll get right back into things and continuing on for the next couple of months. And then we've already been talking about topics into next year. So I will, once we've got the dates, if it's going to be the same dates and same times, I'll definitely make sure that those invitations get out so that way everybody gets the invitations as well. Okay, so a little bit about myself. I am, for those of you who don't know, I'm actually the Intuit Firm of the Future Canadian finalist for 2018. Yay, that's awesome. Voting starts October 16th, so we definitely have lots of stuff planned, and yeah, we will be sending stuff out everywhere, so hopefully we can count on everybody for support. As well, of course, I was the runner-up for 2017. I was voted a top 21 influencer in the Canadian bookkeeping world for 2018. Voted by my peers through Insightful Accountant as a top 100 ProAdvisor of 2018. Hubdoc top 50 accounting firm for 2017. Intuit Firm of the Future runner-up for 2017. I thought I'd check that line out. Black Swan alumni. Mentoring under Ron Baker, Futurepreneur Canada volunteer mentor, member of the Intuit Trainer Writer Network, an Intuit All-Star Community member, a Platinum ProAdvisor firm, Advanced Certified ProAdvisor, Certified QB Desktop ProAdvisor, certified in many apps like Hubdoc, WayPay, T-Sheets, a certified professional bookkeeper through the IPBC with over 20 years of bookkeeping and income tax experience. That list is getting long. Personally, my passions. I love my family. I love unique experiences. So for those of you who don't know me, most of those people, other than that one with my daughter and my husband and myself on a ship, and then my dog Rosie, most of those other people are not my family members. They are actors of one of or two of my daughters and my favorite TV shows and some bands. We actually do like to go to unique experiences and meet some of the people that we like to listen to or watch on TV and spend weekends with them. And again, very unique experiences, and that's what tax season pays for. So that's what gets me going through tax season. And then my daughter and I are learning ASL together, American Sign Language. So just a little bit about Kata Accounting as I introduce them. So I've been collaborating with Jonathan and Bob for a number of years. We have multiple mutual clients. They work great in QBO. I do believe that's their main platform, but they can fill you in on that. They've got huge attention to detail and absolutely outstanding customer service. And because of the communication that we have together and the fact that, they take the time to explain things to me so that I now know in advance what they're looking for, it has definitely improved the quality of my work to the point where other accountants who had still referred to me in the beginning because I did quality work are actually making notice of this and mentioning it to me. So that's absolutely great. I love hearing that because I do take pride in the quality of my work. So yeah, they're definitely the bookkeeper's advocate, or the bookkeeper's accountant, I think, as I was calling them. Anyway, take it away, Jonathan and Bob.
All right. Well, thank you for that amazing introduction. Are we going to share over with our next slides, or are we just?
Yeah, just go ahead and just take control of the screen to start sharing your screen.
Alrighty.
And that's what happens when we take a break for the summer, right? We forget the process.
Yeah, totally.
I just stopped sharing, and then you can start.
All right. So everybody should be able to see my lovely mug there. Thank you for bringing up communication. Can everybody see okay?
Yep, we can see it now. You're good.
Okay. So thanks for bringing up communication. Right on our business cards is communicate, collaborate, and innovate. And really those are the three top values that we're trying to build into a lot of what we do, pretty much everything that we do. And education is a big component of that within the firm, cross-training each other with our clients, with the people we collaborate with, and beyond. And thank you, Tanya, for hosting this series, because this is important to us. The better the entire industry gets, the better all small businesses are served. And in the end, the easier our job is. So I have been considered a thought leader in accounting and technology pretty much since the get-go. I was very fortunate to be a member of the inaugural Intuit Accountants Council. That was a steering committee that Intuit gathered a group of people to, reveal early products, do rapid prototyping. A lot of the things that they're now doing on a wider scale came from that Intuit Accountants Council. We are Platinum ProAdvisor and Intuit All-Star. We're a known collaborator, and I have personally extensive experience in the mortgage industry with rental properties, with e-commerce, and with digital and affiliate marketing. I am a member of the Japanese Canadian Cultural Center's board, so if anybody in the GTA has interest in anything Japanese, get in touch. I'm an avid fisherman and MTG and poker player. MTG is a very, very nerdy game, and if anybody knows what that stands for, they'll know exactly what I'm talking about. So, Bob, what about you?
Good morning and welcome, everyone. It's great to see so many people participating today. Just a quick introduction for me. We have a pretty full agenda to cover today, and we actually may not cover everything that we've prepared in the time, so I'll be quick. I went to school for a while. You can see the details in the page that's before you. Went to school, worked in a CA firm. It was called CA firm back in those days. Went into industry for quite a while, did a bunch of interesting work there. Then I decided I'd go out on my own, so I hung out my own shingle and did independent consulting work for a number of companies. You may recognize some of the names there. The Institute recently very generously appointed me a lifetime CPA, and that's very gratifying at this stage in my long career. I live in Georgetown, Ontario with my wife and our 4 cats. I really enjoy woodworking. Hopefully we'll get more time to do that this winter. And I love following the equity markets and trying to unlock the secrets of how to make money in them. So just to say a little bit about Jonathan, we met many years ago. I don't know how many, Jonathan, but when he reported to me in a consulting role that I was doing, and I saw something there. I saw a spark. And over the years, I've seen Jonathan grow and develop, and it's amazing to see that the spark I saw those many years ago has come to fruition. So when I had the opportunity to throw my hat, excuse the expression, into the ring with him, I jumped at the opportunity. He's a great guy, and I'm very happy to be associated with him.
Thanks, Paul.
You are welcome, sir.
All right. So a lot of this webinar series surrounds period 13. That's, of course, there's 12 months to a year, but when you finish the bookkeeping for the year, that's not it. There's another level of scrutiny. You need to make sure that, various accounts, accrued liabilities, prepaids, all those things are in good shape, ready to go to the accountant for the tax preparation, or for more advanced things, especially if you're seeking financing. There can be a lot of it can be very important because there is a lot of liability in reporting that, and lenders, bankers, potential purchasers, management, ownership. They rely on the statements that we provide. They rely on the advice that we provide. And really, the bookkeeping is the foundation to that information. As I'm sure every bookkeeper knows, garbage in, garbage out. So it's very important that the bookkeeping come in a very strong shape. So today, we're going to be talking about long-term liabilities. We're going to go over a lot of them, but essentially the basics that we're going to cover are the most commonly seen items that you'd likely see in a small business. So just some examples, bonds payable, I doubt anybody sees that in small business. Long-term loans can happen quite often without even realizing it. Car loans is probably the most common. You might have a BDC loan. That could be another good example of a long-term loan. And we'll discuss splitting up the current versus long-term portion. Capital lease is another good example. I mean, is it a purchase? Is it a lease? Those kind of questions need to be answered. Pension liabilities you won't see very often. Post-retirement healthcare liabilities you won't see very often. And deferred compensation, deferred income tax you won't see very often. Deferred revenues are those when you haven't actually earned it yet. So you get a deposit on account. Say, for instance, we receive a retainer, that's deferred revenue until we have completed enough work to recognize that revenue. Deferred income tax is something that we're not going to get into, but it's part of the reason that we commonly use the published CCA rates from CRA for amortization to avoid having to deal with income tax asset or future income tax liabilities or assets. So that's something that, just to make our lives easier. The key definition is long-term is it will not be resolved this year. The current portion will be resolved this year. So Bob, why don't you take it away with capital versus operating lease?
Sure. Two types of leases, operating and capital. An operating lease is the one you're probably most familiar with. The lessee uses some machinery equipment for a defined period, the lease period, making lease payments, and the item is returned to the lessor at the end of the term. The accounting for this is pretty straightforward. You just book the lease payments as expenses. And a lot of people would think that's the end of the leasing story. There's no other way you would treat a lease. You just expense the lease payments. However, we do have this idea of a capital lease that has been around for a number of years. And on this, just to introduce the idea, I like to use the duck analogy. If it looks like a duck, walks like a duck, and talks like a duck, it's a duck, dude. So if a lease looks like a purchase-sale agreement, it is expected to be set up as a purchase and sale and not as a lease where you just expense the periodic lease payments. And then you get into complications so you have to account for it as a purchase. You get into complications like how much do you set up for the capital? And what are the lease payments and how do I account for them when I make the monthly lease payments? So those are topics that are going to be a little bit beyond the discussion that we have time for today. But just quickly, you basically do a net present value at a certain interest rate on the stream of lease payments. So that gives you a dollar amount for today, and you do your bookkeeping entry, you debit a capital account like property, plant, and equipment, and you credit a loan account, a long-term loan on the other side of the balance sheet. So in theory, it's not overly complicated, but in practice, takes a bit of work to set these things up.
I just wanted to jump in there. I heard a little bit of accountanese. Net present value calculation is a commonly used mathematical equation to assign a value to something over a period of time. The key assumption is that money has less value tomorrow than it does today. And I think everybody can understand, inflation is a component of that, and, bird in the hand versus two in the bush kind of idea. So the net present value calculation, don't anybody get hung up on what that is. If you do need help with that, there are a lot of us who'd be absolutely thrilled to help. Bob, did you have any more on this slide that you wanted to go over?
No, that's good. So continuing on with the duck kind of thinking. So capital lease, if a lease looks like a purchase sale agreement, it is a purchase, not a lease. So you ask the question, how can a lease, which has periodic payments, look like a purchase? One of the key things you look at, these are all based on the individual circumstances and the documentation relating to the lease. One of the ways is if you have a lease and it has a $1 buyout at the end of the lease term, and then you own the leased asset. Like that's really a purchase, and you're making periodic payments to purchase the item. It isn't really a lease that you're expecting to go back to the lessor at the end of the term. If the life of the asset is much longer than the lease term, so there's a lot of useful life left after you finish making the payments, then it's indicative of a purchase as well. If the total of lease payments over the lease term is close to the purchase price, and I've seen a percentage like 90% kicked around, like if you total up the lease payments and you compare that total to what it would cost you to purchase the item, if it's more than 90%, you're leaning towards a capital lease. And then if the terms of the lease, aside from the first three items, if the terms are such that a reasonable person would take over ownership at the end of the lease, then you're going to lean towards treating it as a capital lease. So that's how a lease can look like a purchase. And this is a little example, and it's also answering the question, why do we care? Why do we care about identifying capital versus operating lease? Well, it's because a lot of companies, and I worked for some of them, were using financial engineering to set up lease terms, but they were really purchasing the item, but they set it up as a lease so they get a tax advantage. So I just created this little example. Airplanes are something that larger corporations would often lease. And some of our clients may not be buying airplanes, but they may be buying some kind of machinery and equipment. So I just chose a $200,000 airplane as an example. So if we buy the airplane, our tax deduction is going to be at 25% CCA Class 9. So you're going to get $50,000 the first year, 25% of the 200, and then you're going to get declining balances going forward. So very quickly you lose a tax advantage. And the other issue that you need to think about is you're likely going to take out a mortgage for a purchase that large or some kind of financing plan. So now you've got interest and you've got repayments of principal and so on. In year 5, you still have a remaining balance that you haven't deducted yet, and you're going to deduct that into the future. So that's the profile if you buy the airplane. Now, if you find a leasing company, and what happened in the industry is the leasing companies got in bed with people who were buying machinery and equipment and stuff like that. And the lease company, because they were buying 20 airplanes that they were leasing to different clients, they could get a deal from the airplane distributor. So they might buy it for $180,000. So there's a $20,000 kind of amount that's lost in the equation. So they would be able to give favorable lease terms to somebody who wanted the airplane. So they would have, let's say, a 5-year lease term, at something like $42,000 a year, totals $210,000, which is not much more than it would have cost to buy the airplane. So it even based on those facts, it looks attractive for the company to take over and do this type of lease. The other factor is you likely don't need to take out that financing, so you don't have financing repayments and so on. So if we lease, these smart financial people saw that we can deduct the lease payments, so we lose out in year one. Our tax deduction isn't as good, but we start to gain significantly in subsequent years. And when you do all the financial machinery and calculations, it turns out that you can save quite a bit of tax much more quickly by going with the lease situation. And the lease terms often said, you know, pay us $1,000 at the end of year 5, and you now own the airplane. So basically, it was a deferred purchase plan type of thing. So CRA came along and said, no, we don't like this. You are really purchasing this plane based on the terms of this lease, and you have to account for it as a purchase. So it became important in the profession to be able to identify a capital versus an operating lease. And
Okay.
a lot of it was due to CRA kind of stepping in and saying, you're cheating us.
This reinforces the importance of having a really solid bookkeeping foundation when it comes along. I mean, if this all has to be recalculated and adjusted, of course, it ends up costing the client. But on top of that, I mean, it could create exposure for the client and for the accountant and for the bookkeeper. So it's important that that be done. Another just quick comment is this is for example purposes only. The math is not quite 100% perfect, but I just wanted to give that kind of disclaimer. Moving on.
Yes.
Deferred revenue. I spoke about this before. This is payments received before the service is rendered. I use the example of a retainer. So the example we have outlined here is a construction project. It's expected to take a time to complete, say 5 years to complete. Payments are pre-scheduled. They're not based on percentage of completion. Quite often, if you have contractors, you might have situations like this where there's a holdback that has to be listed as deferred revenue until the end of the project and the client signs off on it. But to give this quick example, so 30% is paid in first year, only 10% of the work is done. Well, 30% is $3 million. Of that $3 million, two-thirds of it ends up going to deferred revenue. And this is a long-term deferred revenue. That might be the instance. I've definitely seen contractors where they're working on a project and the project is scheduled to take over a year. So deferred revenue, long-term deferred revenue is definitely an issue. There is a current portion of deferred revenue that does need to be recognized, quite possibly on your own books for any retainers received that you haven't performed the work for. So there is a current deferred revenue as well as a long-term deferred revenue. So Bob, did you have anything to add on deferred revenue? I think that pretty much sums it up.
Yeah, I think that covers it pretty well.
Okay. All right. So, our favorite, Bob.
Long-term debt. We've covered a couple of the perhaps more obscure items that go into long-term liabilities on a financial statement. In our business, this is the one we hit most often, and I'm sure everyone here will recognize that. Long-term debt, which is secured like by a vehicle that your client has purchased, or a building, a property of some sort. And in terms of long-term debt, the issues we have to think about, and that there will be a focus on, is the amortization of the loan. And we see that being done wrong more times than I care to think about. Again, we have to split out the current portion of the principal balance that's going to be paid within the next year and show that separately in the financial statements. And the third thing we wanted to mention was if we're doing notice to reader financial statements, we will likely need a little more documentation and be careful that we have all the information about the debt correct so that we're disclosing things properly in the NTR statements. So just covering those three in a little more detail. The first one is amortization of the loan. So we need an amortization schedule to book repayments. You have, usually it's a flat payment, but it's combines principal and interest repayment. So you split the repayment into two pieces. The interest goes to an expense account and the principal goes against the liability balance that's on the balance sheet. And the problem is we often see people booking the full amount of the payment to the principal balance and reducing the debt more than they should be. And what's going to happen with that is you're going to eventually run that debt balance on your balance sheet down to zero, but you've still got 2 years of payments to account for. So what are you going to do with that? So in order to properly balance it, you need to split the monthly payments between principal and interest, and you need an amortization schedule in order to do that. So I think we have an example of that on the next slide. So here we have the amortization of the loan. This is a loan with an opening balance. I just pulled one from some of the clients that we deal with. So this is a $52,510 opening balance on this loan. The payments are $406.71, and this is a bi-weekly, I think it's called. The payments are every 2 weeks. So what you need to do is for that first period between the 16th of March and the 30th of March, you need to calculate the amount of interest that would have been charged on the $52,510. That is $129.71. So your total payment is $406.71. Your interest is the $129. The difference is the principal amount. And you can see in the principal column, the principal balance has been reduced by the net difference of the principal repayment that comes out of the total payment. Hopefully everyone recognizes that and follows that example. We do, in our work, we do have a spreadsheet. Sometimes the client doesn't even know what you're talking about when you ask for an amortization schedule. We do have a spreadsheet that we've set up that works quite well. You put in the principal amount at the beginning, put in the interest rate, put in whatever the periodic payment flow is, and it will actually crank out an amortization schedule for you. So if anyone would like a copy of that spreadsheet, we are quite willing to share it with you. So the second issue is to split out the current portion. And I can see our time is getting away from us here, so we won't take long on this. It's just out of the principal amount, you have to split the amount of principal that's going to be repaid within the next year, the next 12 months, and show that separately on the balance sheet. So that's something else that the accountant will want to work with. And finally, if we're doing notice to reader financial statements, we put in a note about the loans. We indicate what type of loan it is, what the interest rate is, how long it's going to take to pay it off, what the security is, any other pertinent details. If the loan is from a related person, you would put that in the note. So if you're doing financial statements, notice to reader, your accountant is likely going to come back to you for additional information and documentation. They may not actually ask for the agreement or documentation of the loan if they're not doing notice to reader statements. But if they are, they're likely going to want better documentation in their files.
I'd like to just add on here another common issue that we're seeing in this particular category, particularly when it comes to automobiles, is that, maybe it's a corporation, but the automobile and the loan are actually in the individual's name. And it's very important to define that ownership. There are ways where, the owner can sell the vehicle to the corporation in a non-arm's length transaction that can be tax neutral, things like that. However, it is very important because the number of times we see corporations trying to write off amortization on a vehicle that sometimes isn't even owned by the corporation owner. Sometimes it's owned by his wife or her husband or things like that. So it's very important to know whose name these things are in, because CRA cares. So I did see some questions come up in the chat. I'm just going to scroll back. So
Yeah,
yes,
I was kind
Carol?
of in there, and I was kind of in there answering. So
Okay, so I might
Just-
repeat some things here.
that's okay, and just make sure that I didn't leave anything out as well.
Okay. The first
Okay.
question I see is from Carol. Would this include a vehicle as a lease with a buyout option at the end of the term? I'm assuming we're talking about the capital leases section. It depends on the buyout. So let's say like it's a vehicle lease and the buyout is $20,000. That might not fit the bill. However, if it is, the buyout is $10, then it definitely fits the bill. Suzanne asked if a lease to own contract qualifies. Yeah, a lease to own contract is essentially a purchase. Where are we here? Suzanne also commented about deferred revenue not being taxed in the current year. That is correct. Deferred revenue shows up on the balance sheet, not on the profit and loss. So from a very tax perspective, it shows up on Schedule 100, not Schedule 125, but it is not taken into account and taxed. There are some unusual circumstances where that is not true. Most recently I encountered was the licensed producers in the cannabis industry who are publicly traded. They're governed by IFRS, not ASPE, which is what most private corporations are governed by. And because of IAS, they actually have to declare everything that's in the ground as revenue. So there is no deferred revenue, and they actually can end up having margins that are over 100%. Very interesting podcast, 6-point podcast on CPA Future Forward about that, if anybody's interested. So Tanya, you talked about the holdbacks in the contracting industry. I think that's probably the most common area. That and retainers are the most common areas where you see deferred revenue. Occasionally there will be service contracts that are over a year. And this would act similarly with a prepaid expense such as insurance. You buy your insurance in July and your year end is in December. Well, you've prepaid for the first half of the following year. So that's a prepaid example. And with the deferred revenue, it's very similar. We agree to service a client for a year. They pay us all up front. We have to defer half that revenue until the following year.
Now, Jonathan, that would also be common then for rental situations for the landlords when they're collecting security deposits. So that would be common for them as well. The deposits in the first and the last month rent would be considered deferred revenue as well, right?
Yeah, and typically in that situation, I would classify it as long-term deferred revenue unless you're dealing with student rentals, because typically that security deposit, that last month's rent, isn't actually amortized until years after the lease is initially signed.
Right.
There's a question here on the notice to reader financials. Can an accountant elect not to include notes at all? That's from Karen. We would not do that. As soon as you start to put a set of financial statements together, the notes are meant to be clarifications and additional information, and almost always something on a balance sheet or income statement, you need to talk about something to clarify the situation. For example, the first note will talk about what the business is. It'll give a description. Where is it incorporated? When did it get incorporated? What type of business is it in? So I know some people do prepare notice to reader statements and not include notes. I question whether that meets the professional requirements, and I would not choose to do that. But I'm not. If you know an accountant who does it, I'm not saying that's wrong. I'm just saying there are other ways you can approach it.
When you get in practice inspection as CPAs, the governing body of the province inspects your work. I'm not sure what it is in all the provinces, but in Ontario, they review every notice to reader. And one of the things they might comment on is, a lack of notes or a note that should be there but is not, things like that. So I have heard of it coming up. We haven't had it come up, luckily, but I have heard about it coming up in the past with other accountants. Also, too, it's very important. If you are a professional accountant, you have to have a notice to reader cover page letter on those statements. Otherwise, they're called. I heard was it white back statements? So there's no cover letter, no notes. It's just essentially somebody exported their trial balance or their balance sheet and P&L from QuickBooks Online, and then made it look pretty, and are using those as statements. Those I always discount because and Tanya will attest to this. We do a lot more diligence than is the minimum that is required for a notice to reader. The minimum is we take the numbers, we throw them in, and we send them across, and that does nobody any favors. That's a transactional relationship, not a true partnership, and we're not about that. So to us, the notes can be almost as important as the numbers.
And Jonathan, just to add, in that situation where you do, I think what you called whiteback statements,
yeah,
you should ask your client not to associate you with those statements. As soon as your name is brought in, there are professional requirements. So you should, if you're preparing the statements or the client is using some of the work you did to put together a set of statements, you don't want to be associated with those because you didn't review them or you didn't do any work on them to verify. So you don't want to be associated.
Now, Karen, you had a second question about continuing on with a mistake from a prior accountant. We don't like to do that. We find there's the clients see a lot of value when you do find errors, and I mean it's not to point out bad accountants or things like that. It's really about just serving the client's best interest. And if things are not reported properly, that does not serve the client's best interest. So most of the time, there are very few occasions where I would allow something that I think is wrong. Actually, you know what? I can't think of any occasion where I would allow something that I think is wrong to continue. There are situations where you have a lack of information, and that can be very challenging. And sometimes you have no choice. That has to stay there. It can't be vetted. Maybe it's something that you adjust out after the fact, but that's something that we can talk about offline in more specific.
Yeah, for me, without hesitation, I would say I would split out the current portion and do it for both years. Figure it out for the prior year and show that as well. It's clear cut that that is the proper way to do things. So that's what I'd be doing. And someone else prepared statements another way. That's up to them. I'm going to do it to my best ability and do what's right.
Okay, so the last question I see here right now, and feel free to add more questions. I'm loving this engagement.
Yes,
how does
Suzanne.
income earned but not paid till like 6 months later and not billed till then also? Really, that is, if the income is earned, it should be billed.
Yes.
I mean, you might have very long terms on that billing, but it should be billed. Otherwise, you're violating what's called the matching principle, and that is recognizing the revenue in the period in which it's earned. From a tax perspective, TRA will tax you on all revenue declared, regardless of whether or not it's being collected. But I have seen people play around with this to try and push off revenue until the following year. It's very difficult to catch, but when we do, it bothers me because it really violates one of the very basic tenets of accounting, and that is matching the expenses and the revenue to the period in which they're incurred. In this situation, you might not be recognizing the revenue, but you have incurred the expenses. So, of course, your reporting is not going to be accurate based on the activity of the company. This might fly in a small, very, very small or micro business, but it's definitely something that I wouldn't advise you to do.
Yeah.
Are there any more questions? Sorry, go on.
Sorry, I would just add to that. I don't really care whether the client bills it or not. It should be recognized. So you would debit some kind of receivable account, and you might want to keep it out of your formal accounts receivable where there are invoices supporting what is showing as a receivable. So you could set up another account that looks like a receivable account, but call it unbilled revenues or something. And then when you do bill it, you would move the receivable out of unbilled revenues into your formal accounts receivable. But definitely, if income has been earned, it should be recognized in the financial statements.
Okay, Liz, I like your comment there, setting up the AR at year end. I like the setting up the AR. I wouldn't do it at year end. I do it live just because it's more likely to slip through the cracks if you do it at year end. Unbilled receivables, unbilled revenues, some account like that. Karen, your question about restating the financials so if you restate financials with current portion of long-term debt, do you then have to do anything with the T2 revise and resubmit for prior year and current year? If the interest is correct, it doesn't really make a difference.
Right.
TRA would say, oh, yes, you have to. Would they notice? Would they come back, and would that come back to you as a liability or something? Very, very, very low probability of that. And there's no tax effect. So and that's what drives that probability down is CRA's reviews and CRA's examination of tax filings are always based on potential recoverability. In the instance of whether it's current or long-term debt, there's no potential recoverability. This will be at the bottom of their list to review. So I hope that answers your question. Carol, how do I explain this to a client in construction? Work done to end of the year, but client may not do her invoicing until January. I don't think her accountant takes this into account. As I stated, when you hire an accountant to do a tax return, the bare minimum is the numbers get taken from the books, put in the tax return, everything gets filled out, and it comes right back for signature. As a basic tax return, as a basic notice to reader, there isn't the requirement for the level of assurance that is possible out there through a review or through an audit or working with an accountant who refuses to report fiction. How do you explain that to your client? I would just say, like, any work done to the end of the year needs to be, at least the invoice needs to be set up in that year with that date. You can send that invoice in January, but the invoice needs to be set up in the current year. I hope that answers your question.
The receivable needs to be set up.
Yeah, if I can just add to this. So what we do, there's certain jobs that we take on that are larger jobs, as well as we do have a construction client. And we basically do the same thing. It's like a progress invoicing. So even though QBO is now only capable of doing progress invoicing, we would actually set up an Excel spreadsheet for the client. And so if they're, for example, doing floors, they bill out after each floor. So when they sit down and do their billing in January, they will bill out at the end of the month. So they'll date that invoice for December 31st, for example. But then that way, at least they're still doing a progress invoicing, and then they're dating it into the proper terms. Does that make more sense?
Yeah, that's exactly the process that we
Okay.
were using with contractors until progress invoicing came out. I mean, it wasn't a perfect process. We really do try and get into the system more than having dozens of schedules outside. There's the concept of MESS, which I don't know if anybody knows that acronym, but it essentially refers to problems created by manually entered spreadsheets. And there are some phenomenal stories about how this has just absolutely sunk companies. And probably the most famous is Enron forgetting a decimal place and then just letting that error compound.
Wow.
Yeah. Any more questions?
Yeah, I was just going to say, like the construction one, for example, what they do is the spreadsheet that we set up was a very simple one. And if there's 10 floors, basically, kind of just make note that, yeah, when each floor is finished, they bill out 10%. Or actually, I guess, 10% of the remaining amount, excluding their holdback, because we deal with holdbacks with them as well. So that it's very easy just to sit there and, yep, that floor's finished, build on this date. So it was a very simple, basic spreadsheet, nothing too complex. But now that, again, QBO's got the progress billing, they just send out the estimate, and we're able to just do that, just 10%, make their little notes, and it works beautifully within the progress invoicing. So
That's a cool solution, Tanya, to kind of by number of floors, and I've been involved in some percentage of completion situations on big construction projects, and it is dang hard to for an accountant who doesn't isn't an expert in construction. This $25 million project, how the heck do I know how much of it has been done? You've got the utilities are all in, and the foundation is poured, and your client says, well, this is 2% complete, because they don't want the revenue recognized because they'll pay tax on it. And
right.
You've got to kind of push back and use other expertise, or the senior people from the firm will want good documentation for how much is complete. So your floor by floor thinking is pretty sweet.
I like just keep it simple, and that was something that the owners agreed to. They've got, we pulled together, again, very simple, easy sheet, so it was easy for the person in the office who's handling that, and it was also acceptable to the because they were questioned a few times, which is what caused us to create this, by the company that they were doing the building, like the construction for. So they were questioned. So it was approved, like all around by everybody, that it was a nice, fair, easy way of doing it. Like I say, pulled together just as simple as ridiculously easy spreadsheet. But that was, it was the best way that made sense to everybody and kept it easy.
I'd like to just jump on that comment a bit more, just from an actual business, because we are all entrepreneurs. From a business standpoint, it's very important to keep supervision or some degree of your finger on the pulse of what's happening with the vendor when they are billing by percentage of completion. I've heard horror stories in the real estate industry where a developer is working with a builder who's billing them percentages that aren't actually reflective of the work that's done. They pay those bills, and then it gets to the end of the project, and they're way over budget, and nothing's done on time, and it always results in lawsuits. And I don't know if anybody else has noticed this, but building companies tend to pop up and disappear pretty quickly. Most new builds are actually completely separate corporation, and it can create a lot of legal issues if something funny is going on. I've also unfortunately experienced this firsthand in the web services realm. You have to be very careful. Check references. Get the pedigree of the people you're working with. It doesn't matter if you found them online or if they're around the corner. I've seen some absolutely completely unethical behavior in this realms where people are doing things and then telling you that they've done X, and when you actually see the work, they haven't done anything that they said they've done. And there's no governing bodies in that area, so it's not like we can go out and hire the equivalent of an IPBC and be assured of a certain standard of quality, which makes it very interesting. Of course, this is very prevalent in the crypto world right now, and in the AI world, people claiming that they have something that they don't. So just heads up.
I've been a victim of that myself. My value pricing template, when we tried to get that online, I lost $5,000 to somebody who was supposed to create something. I told them exactly what I wanted. I had pictures, I had everything, and when it came back, it looked like a kindergartner had put it together, and it looked worse than what it looks like as a spreadsheet. So I had to go back to the drawing board, start all over. I could not get the money back. And it's I did not do my due diligence where I obviously should have. So there was a little more I could have done, but.
Okay. Well, I don't think there's any more questions. Thank you, everybody, for joining us. I love the engagement today. Really, really appreciate that. And if there's anything,
I think we set a new record with number of participants today. 15, I see.
Well, I sent that reminder because we do have over 50 that are signed up. But the problem is it's 7 a.m. Pacific time, so any of the West coasters can't necessarily make it as easily. So can I just get, because I know there was some question in there that amortization schedule, is it possible just to send that to me, and then I can send that out with the recording link? Is that okay?
Yep, I've already started to look for it, to pull it out, so I'll shoot it to you right away.
Beautiful. Oh, look, Carol and Suzanne made it. Okay. They're West Coasters. They made it. That's awesome.
Hey, that's it kind of hurt for me to get up in time for this morning. So somebody getting up to be here at 7 o'clock, my hat's off to you.
Awesome. Okay, well, great. I will stop recording now, and I'll have everything sent out tomorrow. And yes, thank you again, Bob and Jonathan. This is absolutely amazing.
Cheers, everyone.
Have a great day, everyone.
Thanks. Bye, everyone.